Up, guys. Thumbs up. Thumbs up. Hey. All right. Happiness. Welcome everyone to the Task F feedback session. I am Katlego Marumo. I am a tax lecturer here at Indulamu, and I'm going to be specifically, obviously, taking you through the tax task that we found in the OTA case study. Okay. So, ladies and gentlemen, I sincerely hope that you are going to be taking away some valuable points throughout the session. So please feel free to engage. I don't know if I should even be prompting you to engage, because I did see a lot of activity in the previous session. So continue to ask questions, give commentary, and let's make sure that we learn from one another. Okay. So with that said, I just wanted to put my camera on so that I can just greet everyone, but I am going to turn my camera off so that we can obviously then have sufficient bandwidth throughout the session as well. Okay. All right, guys, let us start. So before we actually get into the information on the day, I just have a quick question for you. Did you have the opportunity to reflect? In other words, have you all had the opportunity to watch that reflection screencast, which was facilitated by Tina, where she took you through that pre-release information? If so, please give me a thumbs up. I'm not seeing much thumbs up. Okay. So guys, it is important, very, very important that you take the time to go through that pre-release or reflection screencast, specifically focusing on document 6, because that is where we were introduced to the text trigger. So for those of us who haven't had the opportunity or the chance to work through that reflection content, I just want to give you a high level of what was covered before we actually get into the information on the day. Okay. So like I said, it's important to take the time to go through that reflection analysis, because it gave great insights as to how to identify the trigger. In other words, the tax problem that needs to be solved. So every single time you are reading your pre-release and trying to identify triggers for each of the various disciplines, you need to think about what is the problem that I'm going to need to solve with respect to the information that they're giving me. And that right there will give you then the trigger that you are supposed to go do further research on. Okay. So that reflection screencast took you through the trigger as well as what you needed to do during the research phase in order to adequately prepare for the task. So in document 6 of your pre-release information, we were told that the deadline for submission of the tax return for FY22 is due at the end of the month. And Tanya, who has now since left the entity, assisted with all the tax matters, as well as the reporting on our tax numbers in the financial statements. So I like a phrase that one of you guys was saying, that there's no information that is given just for yes, just for the vibes. And that is 100% true. Sorry, I just saw a comment that came through here. Will this session accommodate ICAS candidates? So thank you, Nathan, for that question. Ladies and gentlemen, before I continue, for the ICAS candidates, there's going to be a separate screencast video that I'm going to record. This particular live session will only focus on the SAICA tax task. Okay. So let's see. Thanks, Ele. I see you included that comment there. And yes, happy if you do stay on so that you can pick up on a thing or two in terms of exam technique that we'll talk about, but that will also be covered by that ICAS screencast that I'm going to record. All right. Okay, guys, moving on. So we were still talking about what we needed to do in terms of that reflection, the reflection screencast. So we said that we were told in the pre-release that the deadline for the submission of the tax return for FY22 is at the end of the month. And Tanya, who has since left the entity, assisted with all the tax matters and the reporting on our tax numbers in the financial statements. And then I just said, in all information that is given to you in your pre-release as well as information on the day is important. So you need to read it with understanding and consideration of the impact that that particular information could have. For example, in the pre-release, they tell us that Tanya assisted with all tax matters as well as the reporting on our tax numbers in the financial statements. So if the person has left and they worked on these particular two disciplines or two items, that means that you are going to need to have an understanding of both those items. So you are going to need to have an understanding of the tax matters that may be applicable to OTA. And then you are also going to need to have an understanding of how would I report these tax numbers in the financial statements. So during your pre-release, it's also something that you would have researched on so that you have a solid understanding of how tax numbers are reported in your financial statements and what goes into the various reporting lines. So we were then further told in the pre-release that Julio has been asked to step in and handle this matter, and he will send his calculation of the income tax liability as soon as possible. So the CFO has also asked you to step up and assist. And that right there was the trigger. You are going to need to assist Julio, who's going to be handling this matter. What matter? The tax matters as well as the tax numbers in the financial statements that Tanya previously did. And then Julio is going to send you the income tax liability calculation. So they were very nice to us in this pre-release because they helped us focus when it comes to what we are going to be researching on. Not all applicable tax matters that would be relevant to OTA. The income tax liability is what you are going to be doing extensive research on in your pre-release phase. Okay. Now, as advised in the reflection screencast, if you did have the opportunity to watch it, seeing as you are going to be assisting with the income tax liability calculation, you needed to create some sort of expectation in terms of what you would expect OTA's income tax liability to look like. But please, ladies and gentlemen, that expectation needs to be in the context of the information that is provided about the entity in the pre-release. So when you are creating this expectation and you are doing maybe a rough draft of how you would expect this income tax calculation to be computed, you're not going to put all possible income tax adjustments you could ever think of, because that's going to waste your time during that research phase. You are going to think about what would be the possible tax adjustments in the context of the information that is provided about this entity. So what is this context? Context is everything, ladies and gentlemen, because it will guide the technical items that you do detailed research on and ultimately then guide the depth of your file. Because a lot of people struggle with having just a lot of information in the file, and now you get to the exam, you are, overwhelmed because you don't even know firstly where to start looking. What's going to help you with overcoming that during your pre-release is making sure that the things that you are researching on in detail are things that are within the context of the pre-release information that you have been provided. So in this case study, what would have given you context about the types of tax items to research on would have been the financial statements, as well as the background information that we were given about the entity. So what do I mean? For example, in the background information, we were told that OTA leases the aircrafts that they use. So that right there says to me, I need to do extensive research on leasing, right? What are the income tax implications when it comes to leasing? Now, I don't know on the day if they're only going to be focused on the lessee's perspective, which is OTA because they're leasing, or is there some spanner in the works where they're going to ask me from the perspective of the lessor? So I need to know there's leases happening here. I'm going to research on both elements, and that is what I'm going to be focusing on. Why leases? Because it's coming through your background information as transactions that are happening in this particular entity. Then they also tell us in the background information that OTA is going to be responsible for the insurance and maintenance costs. So that right there would have been a trigger for you to research in detail on Section 11D. That is, when are repairs and maintenance costs deductible? And then also research the deductibility or consider the deductibility of all other costs noted. Because in your background information, it's not just the maintenance cost that they give us. They tell us that they're responsible for things like insurance. So you're going to need to think, okay, there's a lot of costs that they're incurring here. Holistically, let me remind myself about Section 11A, the general deduction formula. What does it entail? Okay. So that's helping you now focus once again on the things that you are researching on. Like I said, there was financial information that you were given. So if you looked at that financial information, you would have seen various revenue items. They also gave you further details about what those revenue items entailed. So that could have guided you to go and refresh on that gross income definition. What constitutes amounts that actually are included in gross income? Okay. Capital allowances would also have been something that you probably research on, because you would have seen from the financial statements that they have various assets that they depreciate. So that tells me that from a tax perspective, I probably need to consider wear and tear. So they gave you also an explanation on the type of assets that they have there. So either through a description, they told you there's right of use assets. So you need to already formulate in your mind what you would have expected them to do from an income tax perspective with respect to right of use assets, for example. We saw things like interest. We saw leasehold improvements on the financial statements, prompting me now to go and do further research on Section 11G. I need to make sure that I understand Section 11G inside and out, because I don't know what they're going to be asking me on the day. And why am I researching Section 11D once again? It's coming through that information that you are given. Okay. They told us from an accounting point of view, when we looked at the financial statements, that they were incurring accumulated losses. So if from an accounting perspective, they are incurring accumulated losses, there's a strong chance that from a tax perspective, they will ultimately end up in an assessed loss position. So that says to me that I need to go do further research on assessed losses. Let me understand how to treat assessed losses from a tax perspective. But please, ladies and gentlemen, that's not to say, for example, if they were making profits, then you wouldn't research on assessed losses, because assessed losses form part of your understanding of the income tax liability. But the depth that you would go to or go through in your pre-release when you have a profit versus an accounting loss would be different. Maybe if I had a profit, I would just
You are muted. Why are you guys doing that?
Hi, guys. Can you hear me now?
Yes, we can hear you.
Yes, we can.
Please tell me that you heard me at least from 20 past 8, or have I been muted since?
No.
No, you just got muted for a few seconds.
Oh,
few
okay,
seconds.
okay. So I'm just going to go a step back and just reiterate that what I was saying is, for example, from an assessed loss perspective, you would have seen from the financial statements that from an accounting perspective, they made accumulated losses, right? So that says to me there's a strong chance from a tax perspective that they may have assessed losses. So I would have researched in detail in terms of understanding the principles surrounding assessed losses and how I treat those from a tax perspective. But that's not to say that if they were in a profit perspective, then I wouldn't research on assessed losses. I still would, because if there is an assessed loss, it forms part of your income tax liability or understanding of your income tax in that regard. But the depth that I would go into if they were in a profit position versus an accounting loss position would be different. Okay. We also saw things like deferred revenue. We also saw things like provisions. So I needed to make sure that I'm researching and understanding how to treat provisions from an income tax perspective and why we need to treat provisions in that particular way from an income tax perspective. And then I already touched on the financial statement disclosures, where I said that that was important for you to go and research on to get an understanding of what tax disclosures would be applicable from a financial statement perspective, because we already told that Tanya not only, just worked on your tax matters, she also helped with the reporting of the numbers. So you needed to have an understanding of how do I report tax numbers on my financial statements as well. So guys, is it making sense? If so, please give me a heart reaction before I move on. If not, please type your question in the chat. Daniel or Daniela, I think your hand was up. Oh, I'm seeing a heart now. Mulalo, you are saying yo. What happened? Mulalo? Okay, guys, Mulalo doesn't want to speak to me. Oh, you got muted. No problem. Okay. So guys, I've tried to give you a high-level overview of what's in that reflection screencast. Please make sure that you go through it because Tina explains all the things that I've just tried to high-level talk about in detail. You will get a lot more from that video, so please go and look at it. So let's get into the feedback, what we call this session of our actual sorry, I'm getting distracted here because I'm trying to move over, but my cursor will not allow me to. Okay, let's see if that helps me. Right. So what we are going to be tackling now, like I said, is the information on the day, and then we are going to discuss how you needed to adequately respond to this task. So the requirements for task F were included in document F, and it reads as follows, okay? It says, hi, Julio has forwarded his workings to me for the purposes of preparing the 2022 year of assessments income tax return, okay? I have attached them to this email. As previously mentioned, I would like you to assist me with this. Because this is the first time that Julio is performing the calculation without Tanya's oversight, please undertake a critical review. So what does this mean, ladies and gentlemen? If someone is asking you to review something, if you are asked to review something, that means you are supposed to identify any issues or concerns or errors or omissions with respect to the information that they've given you, okay? Please, ladies and gentlemen, from a exam technique and time management perspective, do not address things that you believe have been treated correctly, okay? We do not address those items because when we're talking about a review, we are talking about issues or concerns or errors or omissions that you have noted. So the omissions part is very, very important because that not only obviously addresses the requirement of the task, but it also shows that you have critical thinking skills because you are not just looking at what's already presented to you and identifying issues with that. You are also looking at things that you would have expected to be there, but they are not there, and therefore you are addressing them or raising them as omissions from the calculation or from whatever document you have been given. So don't just focus on whatever has been presented and look for issues, concerns, errors, etc. Think about the omissions as well. And those omissions will stem from your expectation of what should be there based on the information that you were given in your pre-release, as well as information on the day. Another thing about a review, ladies and gentlemen, is when they ask you for a review, your response about each line item that you are reviewing needs to include 3 components. You need to identify the problem, explain why this is a problem, and then what is the correction that needs to be implemented, or what sort of additional information do you need in order to ultimately form the appropriate conclusion on that particular matter. So Saika was nice in this pre-release, or rather this information of the day, when they said, consider each reconciling item, and if it is incorrect, partially correct, or needs further clarification, please provide him with the correct treatment or state what additional information is needed. That to me was a bonus, because when you have a review, if someone's asking you to review something, they don't have to tell you that you need to give them the corrective treatment or any other additional information that you need to adequately conclude on that information once you've identified an issue. Because to me, if you've identified an issue, think about it. If someone is reviewing your work in your respective places of employment, and they say to you, hi, Tom, so you did this particular thing wrong. I mean, in your mind, you're thinking, oh, okay, why? Why are you saying I did this wrong? Then you will probably ask them why. Then they give you the reason. And then you're also now thinking, oh, okay, so how am I supposed to fix this? So you are supposed to make sure that your review has all of those components in order for it to be a holistic review. Okay. And then we are also told that please also highlight which, if any of the reconciling items would have impacted the FY22 tax rate reconciliation. Right. So this is now the second component of this particular task. It's very important that in any given task, you analyze the required or what is actually being asked of you to understand how many elements do I need to address within this particular task. So here there's two elements we need to review, and then we need to highlight for any of those reconciling items which would have had an impact on your tax rate reconciliation. And this is a fair ask because during your pre-release, they told you that Tanya looks at or reports on those income tax numbers. So part of the reporting that you would see from a tax perspective is your tax rate reconciliation. So you would have researched what a tax rate reconciliation is, the type of items that go into a tax rate reconciliation, and you would have included a note for yourself that whatever is a permanent difference in your income tax calculation is then a reconciling item in your tax rate recon. Are we all happy so far, ladies and gentlemen, in terms of understanding the number of elements within the task and how we would have needed to approach it? Okay. Let's see, Tapiso, please explain in simpler terms why we need to add back prior year allowances on doubtful debts and prior year deductions of provisions. Last, please also cover why we need to deduct the lease payments disclosed. Okay. Let's talk about this one. So in terms of your provisions, ladies and gentlemen, whether it's your, the provisions of any nature, bonus, leave, doubtful debt provisions need to be added back in your tax computation because they are not a cost actually incurred. You do not have an unconditional obligation to settle that amount as yet. Okay, so if you think about the definition of a provision from an accounting perspective, it's a liability, but with uncertainty, either when it comes to the timing or timing in terms of when you need to pay it or the amount. So there's some sort of uncertainty there. So you don't have an unconditional legal obligation to settle it yet. So from a tax perspective, it is not actually incurred, right? So now you need to make sure that whatever movement, if you think about how provisions are accounted for from an accounting perspective, what do you do when you raise a provision? You debit an expense and you credit a provision, which is your liability in your balance sheet. So in your profit before tax, you have an expense that is sitting there that is not actually incurred. So what you need to do is make sure that you add it back, right? However, if this provision was there last year, think about it. If it was there last year in the prior year of assessment, you would have already added it back in the prior year of assessment, right? So in the current year of assessment, we need to make sure that we reverse the opening balance of your provisions so that only the movement in your current year provision is taken into account in your tax adjustment, because only the movement in provisions would be included in your profit before tax. Is that making sense, guys? And another reason why we then need to make sure that when we add back the current year balance, we are deducting the prior year balance is so that we can make sure that any payments, right, that we've actually incurred in the current year with respect to that provision are also taken into account in your income tax calculation. Because think about it, how would a payment be recognized if you are paying this provision? You would credit bank and you would debit the actual provision. So when you are bringing in that opening balance as a reversal and you are adding back the closing balance, you are going to make sure that whatever movement was included in your profit before tax is adjusted for, but also whatever payment is also taken into account. So what I've just described now is the balance sheet approach to adjusting for your provision balances. Another person can take a different approach, and which is quite important, guys. When you're describing your adjustments, it's important that you are aware of whether you are describing the adjustment from a balance sheet perspective or from an income statement perspective. So what I've just spoken about now was the balance sheet perspective. Okay. From an income tax perspective, how would you describe it? If you say to me, with respect to your provisions, I need to make sure that whatever movement is sitting in my profit before tax needs to be adjusted for, i.e. added back, that's fine. I can give you like half an indicator if it were even possible, but that's not complete because you haven't told me now that in addition, I need to also make sure that I bring in a deduction of whatever was paid with respect to that provision. Because the minute you are saying you are adding back the movement in your provision that's sitting in profit before tax, then you haven't addressed the balance sheet approach, meaning you haven't addressed any payments, because no payment of a liability or a provision would go through your profit before tax. Your payments would be credit to bank and debit to the liability. So nothing sits in profit before tax. Always remember your starting point. I'm starting with profit before tax. So if I want to make sure that I'm adequately adjusting from a tax perspective, I either need to describe it from a balance sheet approach, which is add back current and deduct prior year balances, which would encompass everything because I'm using balance sheet amounts. But if I say add back movement in profit before tax, then I need a step further to say deduct whatever payments you've actually paid, if any, with respect to those provisions. Okay, guys. So that's, I think, would answer that particular question. I just want to see if I'm missing anything. Lastly, why would we need to deduct the lease payments disclosed? Okay, guys. So with regards to your leases, right? This is from the lessee's perspective that we are talking about now. And the opposite would also apply for the lessor. With respect to leases, from a income tax perspective, right? All your IFRS 16 adjustments are exactly that, accounting adjustments. The only thing that the Revenue Authority, in other words, SARS, knows or cares about is your actual costs that you have incurred. So you need to reverse whatever interest that you have recognized from an IFRS 16 perspective, because that's an accounting adjustment, such that only the cost that you've incurred, and what's the cost that you've incurred? It's the actual lease payments that you have actually paid. Those are the ones that you can actually claim as a deduction. All right. And that's simply the reason you are deducting your lease payments, because those are the actual costs that you have incurred. Then you are adding back whatever depreciation on the right of use assets, whatever interest on the actual lease liability you are adding back, because all those are accounting adjustments. And right now we only care about what impacts tax, and what impacts tax is your actual costs incurred, going back to your Section 11A general deduction formula. Okay, guys. Okay. Let's see if there's anything else. Zama, I see your hand is up. Sorry,
Yes.
guys, I'm seeing hands here, but I'm not sure who came first. Oh, joke's on me, I can actually see numbers here. Sorry, Timkosi, Zama.
Yes, can I just go on?
Yes.
I don't know if maybe I have a little bit of a gap in understanding, but in that point of the bonus provision, I would have argued that the tax the tax implication would be the bonus that we will actually pay. That would mean that that is the actually incurred value. So I argued that we can't include just the normal employee costs, including the movement, but we must remove the movement and the provision, but just add the cash payment that was actually made in the year of assessment. But because the cash payment is made 3 months after year end, that will be only deductible in the next year of assessment. So ultimately, we only including the payments we made for bonuses that related to the last year of assessment. If you know what I
Yes,
mean. So I'm just looking at payments. I wasn't adding a balance plus last year's provision. I don't know.
yes, no, and you don't have a gap in your knowledge. I don't want you to, if you formulated a train of thought, I don't want you to lose it, because this train of thought that you are on is absolutely correct. We are only supposed to deduct what you've actually incurred, which is what you paid, right? With respect to the provision. So what I'm talking about is if there's any increase in that provision, the actual provision that they're providing for, that would be adjusted for. We need to add it back, because that is not a cost that is incurred, because the only cost that is incurred, like you are saying, is the payment that has been made. So in your train of thought, you are only addressing one part, which is the deduction. And the deduction you can get if you've actually paid that bonus, right? But you are not addressing instances where they have increased or decreased that provision for whatever reason. Remember, provisions are estimates, right? So this year it's this amount, next year is this amount, and if there's any movements that they recognize with respect to that, then then that needs to be adjusted for in your income tax computation, because it's not an actual cost incurred. So what you are describing is sort of like the income statement approach, but you are missing that deduction leg. I mean, that add back leg.
Okay, thank you so much.
Okay. Temkosi, I'm just going to take Temkosi's question for now, guys. Then we're going to just move on and look at the information that we were given so that we can do a line-by-line review. And then some of the questions that you probably have, we will address as we go through all of those individual items. Okay. So Temkosi?
Hi, can you hear me?
Yes, I can hear you.
So I wanted to take you back to the provision, right? I think, yeah, no, it's not registering properly. So, can you please explain it again, like the balance sheet method that you actually mentioned? Like, I got the part that, we will like you said we will reverse the opening balance and then we add back the closing balance, but we need to also take into account the movement and the payments. Can you please like explain that again? And if you're able to use like numbers, basic numbers, please, I would really appreciate that.
Okay. I'm opening an Excel document here. Then I'm going to try and do like a quick example. Sorry, it's just taking a little bit of some time to open here. Let's see. Okay. Let me stop sharing. Then I'm going to share this Excel document. Please let me know when you can see it. Can you all see it, guys?
Yeah,
Please unmute. Okay.
yeah,
All right.
it is showing.
All right. So, hypothetical situation, right? We are given a profit before tax, let's say of 10,123,000. Happy, right? Then we are told, right? In your statement of financial position, right? We are told that your opening balance of your provision, let's say it was 20,123, right? Then we have a closing balance of the provision. We see it as let me see. This needs to make sense. 35,000, right? Then we are told, maybe in additional information, that to get to this closing balance, let's say we had an increase in the provision, let's say of, I want to see what's 20, yeah, let's say we had an increase of 20,000, right? So that's the increase in the current year. Then also, as in that closing balance, we had a payment, right, of 5,000.
We can't see the presentation. We can't see the presentation.
Really? Let me stop
No,
sharing.
I can. I think
No, we
maybe
can't
it needs to
see.
gain and out.
Oh, you can see. All
I can
right.
see too.
Sorry,
I can see.
sorry.
Sorry,
can
sorry. Please, join us again. Okay. So, okay, guys, we have a profit before tax 10,000. We can see in our balance sheet that whatever provision we are talking about has an opening balance of 20,000 and a closing balance of 35,000. And they tell us maybe in additional information that in the current year, let's say this is the leave pay provision. The leave pay provision was increased by 20,000, but there was another payment that was made for leave of 5,000. So what would have been the journals that they recognized? How do you recognize an increase? You obviously debit an expense, right? Happy? Leave expense. Is it making sense? With 20. And you?
Yes, all making sense.
Yeah. And you credit your provision with 20. Happiness. Then you made a payment. How did that payment? You debited the provision with 5 and you credited bank, all right, with 5. Happiness. So I'm here calculating taxable income. I start my taxable income calculation with my profit before tax. Okay. Okay. I need to adjust. So you can decide to do the balance sheet approach. So the balance sheet approach of this adjustment that you are doing would be an add back of the closing balance, right? And a deduction of your opening balance. 8 minus 20 on the same page. So your net taxable income will be the sum of all of these stuff. Happiness. On the same page, guys? Hello?
Yes, yes.
Okay. This is balance sheet approach. So in your description, in your response, if you're not doing an actual calculation, if you're actually writing it out, you would say with respect to your provisions do not represent costs actually incurred. So we are going to need to make sure that we add back the closing balance and we deduct the opening balance to ensure that the movement in your provision, which is inclusive of your payment, because you agree with me that this closing balance includes the payment, right? So you make sure that the add back of your provision, which is inclusive of the payment, is taken into account in your tax calculation. That gives you an indicator. Another person can say, okay, let me describe this as income tax approach. I start with my profit before tax. What went through your income statement here in this example that I gave you? What went through your income statement? Which amount?
The 20,000.
The 20,000, right? Okay, maybe I shouldn't put this here because now it's going to confuse you. Let's start a totally different one. What went through my income statement was the 20,000 and it was an increase in the provision, which means it was an expense, right? So I'm going to need to reverse the expense. How do you reverse an expense? Tell me. How do you reverse an expense in your taxable income? Add back, right? So this is my income statement movement that went through my profit before tax. I'm going to need to add back the 20,000. But I'm saying to you, you also need to take into account the actual deduction that you've actually incurred. which is what? The payment, right?
5,000.
It's payment. That one you can claim as a deduction, minus 5. So what is your net here? It's the same. So whether you do the balance sheet approach or you do the income statement approach, you will get to the same taxable income. It's just the way you describe it. So if you describe it through the balance sheet and say, okay, I need to make sure I add back the balance and deduct the opening balance, that's because it will ensure that whatever movement in my provision, including whatever payments, will be taken into account in my tax calculation. We give you an indicator. Or if you are describing it as an income statement approach, you are going to say the 20,000 movement that went through my income statement needs to be added back because that's not a cost actually incurred. But I actually incurred a payment of 5,000 and that can be deducted because that's what I've actually incurred. It will take you to the same thing. So you need to be cognizant of what you are dealing with when it comes to provisions. Am I dealing with balance sheet or income statement approach? Both of them give you the same answer. Happiness.
Thank you so much.
All right.
Thanks.
Happiness, guys. Let me stop sharing and then let's continue in the interest of time. Okay. What do I need to share? My slides. We were here. Can you see it?
It's easy like that. Yeah, it's kind of like
Someone is unmuted, guys. Kindly mute.
Yeah, we can see it.
Okay. All right, guys. So we are now in the thick of the information on the day. What did they give us? They gave us the actual income tax calculation. Then they also gave us a second attachment, which gave you additional information about the numbers that they included in the income tax calculation. And it's quite important that during your reading time, you are sufficiently using that time to get a holistic understanding of the information that's being provided, guys, in the case study, because the APC is an integrated exam, all right? Some information that you use in a particular task could be coming from information from another document in a particular place in your information on the day. So stay away from reading information in silos. Use that reading time, to the best so that you get a holistic understanding of exactly what is happening across the scenario, so that if there's anything that impacts your particular task, you can pull it from different places. In this particular case study, we were lucky enough that this additional information that they gave us as a second attachment, right, to the very same document, which is document F. But in some case studies, maybe this other information would have been sitting there at the beginning of task A, but you needed to pull it through. So I'm just reminding you that read your scenario in totality so that you have a holistic understanding of what's going on. All right. On that note, let's start with the loss before tax, okay? They have a loss before tax of 54 million. What I would have done for myself is I would have corroborated, or in other words, agreed this 54 million to the 54 million that we were given in our pre-release in your financial statements. So remember, in your financial statements during your pre-release, they gave you the income statement, so you could see that they have a loss for the year. So just as a check for myself, does this 54 million agree to the 54 million that I know from the pre-release? If it doesn't, then boom, here's one review that you can include there and say, hey, your loss before tax that you used in your tax calculation doesn't align with your actual financial statements, so please make sure that we are using the correct numbers. Another thing that could help you demonstrate critical thinking skills is if there's other things in other tasks, for example, in an accounting task that would have affected profit before tax, it wouldn't hurt you to write a little note and say, please make sure that whatever adjustments are coming through from task A, for example, are also reflected in this profit before tax, because we need to make sure that we are starting our tax calculation on the correct base, right? So, but please, ladies and gentlemen, that would only be relevant if those adjustments would have affected the 2022 profit before tax. Because remember where we are, right? We are calculating 2022 taxes. Okay. So that would have, in my mind, also been something I would check. If there's something that would have affected this profit before tax from 2022 and the other tasks, I would have written a one-liner. That shows critical thinking skills, because you are not just focusing on your task. You are pulling stuff from everywhere that are relevant, please, relevant to this particular task that you're doing. Don't just pull stuff for the sake of pulling them, because that's also not going to cut it. Pull stuff of relevance. Okay. Then we start here, ticket revenue. Okay, guys, sorry, just disclaimer. I'm not able to see hands or any questions. Please feel free to stop me if it's really, really something that you need us to address there and then. Okay. Ticket revenue. Remember, you are going to go line by line. When you are reviewing something, line by line. If there's anything that you take out of this session, line by line. Do not forget that phrase. Ticket revenue. This person says, no adjustment. It meets gross income definition because we are taxed on the area of receipt or accrual. Okay. Then they say ACSA, passenger service charges amount should be taxed as it was received by on time, even though it did not accrue to the company. All right. So ladies and gentlemen, now it's important that you are pulling through from your pre-release information, because we were told in our pre-release what these service charges are. Okay. So if you just remember and circle back to that pre-release, I just want to quickly scroll here. So if you have your pre-release document, I suggest you open it up. So we were told in our background information, so notes to your financial statements, that with respect to our ticket revenue, it said that ACSA charges airlines such as on-time passenger service charges, aircraft landing fees, and aircraft parking fees for the use of its facilities. Okay, so landing and parking fees are dependent on the weight and... Hello? Do you want to say something? Okay, so I'm going to continue. So in your pre-release, you were told that included in your ticket revenue, ACSA charges airlines such as on-time passenger, service charges, aircraft landing fees, aircraft parking fees for the use of its facilities. Then they tell us that the landing and parking fees are dependent on the weight and origin of aircraft landing at ACSA operated airports, and it is recovered directly from the airlines. Then we are told that passenger service charges are recovered by ACSA based on the air tickets purchased by travelers. Okay. So now the distinction now between these landing and parking fees versus these service charge fees. With the service charge fees, ACSA recovers this amount based on the ticket that are purchased by the travelers. Okay, they're getting this money directly from the tickets that are purchased from the travelers. But the landing and parking fees, the airlines need to make sure that they pay, who's this? ACSA themselves. So there's a distinction between these two. That means that any ticket revenue that is included now in OTA's financial statements, which includes your service charges, is not income that is for the benefit of OTA, right? It's actually for the benefit of ACSA. So that revenue cannot be included in OTA's taxable income. So the person who prepared this calculation is right with respect to the first part, that your normal ticket revenue would be included in your gross income because it's a receipt, which is we are taxed on earlier of receipt or accrual. But with respect to the service charges, they can't say those should be taxed because they are not received for the benefit of OTA. Because ACSA is going to take this amount of money directly from the ticket sales, so directly from the customer. So if there's any of that revenue that's somehow sitting in that ticket revenue line item, it needs to be adjusted for. So please, ladies and gentlemen, when you are describing or responding to the relevant adjustments, you need to use verbs like doing words. Don't just use words like I've just used, like adjust. Please mute. Don't just use words like I just used, like, and said adjust for the ticket revenue. What does adjust mean? If I have revenue that is sitting there, how do I adjust for the revenue? You must deduct. So use verbs, use doing words, action items, so that the reviewer knows exactly what to do when.
You're muted. I think someone was trying to mute everyone, and they muted you as well.
Thanks, guys. All right. So what I was saying is, please make sure that when you are describing your tax adjustments, right, you use actual descriptive words, words that have actions. Don't just say adjust or reverse this particular number, because that's not telling me what I need to do. Tell me that I need to add back a number, or tell me that I need to deduct a number, or tell me that I need to multiply a number, something. I need to understand exactly what that action item is when you are explaining your tax adjustment, okay? So with respect to your ticket revenue, another angle that other people could have taken with respect to the service charges, they could have said, maybe you are right in saying that the service charges should be taxed if, based on the Pyatt case, that income was not included in a separate account, in a separate deposit. However, if you took that stance, then it is also important for you to take it further and say, if that's the case, that service charges can be included in revenue, but OTA would also be allowed a deduction of those amounts once they pay them to ACSA. Okay, so it's quite important that if you are going to be taking that angle and say, okay, we could probably tax this amount because if it was not kept in a separate account as per the Pyatt case, then it would possibly be regarded as OTA receiving this amount for their own benefit. However, if we do include it in our gross income, when OTA subsequently pays it to ACSA, we need to make sure that they can get it as a deduction. Okay. So you will note, I do know that there are some people who have access to the solution. So if you do have access to the solution and you note this point that I've just spoken about, it's two angles. If you brought them up on the day, that's brilliant. Happiness, we love that. But don't feel pressured now to say, oh, no, this is unreasonable. How could I have thought of both these things? If you only thought of one, which is the fact that you haven't received this amount for your own benefit, that would have been sufficient to grant you that indicator of competence. The other angle that you looked at would have probably given you a high level indicator of competence and also showed you your critical thinking skills there. So the solution is quite comprehensive because it needs to cover all angles, but you need to make sure that at minimum, you at least know what should have been done with this service charges. And the one that's glaring for me here is that those service charges belong to someone else because they take it directly from the customers. So they're not received for the benefit of OTA. Okay. So if I were to, for example, bring in the 3 review components. So remember I said in a review, you need 3 components, right? I said you need a problem, identification of the problem. You need a reason why, and then you need to tell us what is the correct treatment. What should I do now to adjust this? So if I give you an example, with respect to this particular ticket revenue item, I would have said something like, you have incorrectly suggested that the service charges are taxed or they are included in the correct in the taxable income calculation. So I'm telling them the issue. The problem is you included these service charges, you didn't adjust for them. Why is this an issue? This is a problem because the service charges are not received by OTA for their own benefit, right? Okay, so what am I supposed to do with this? You were supposed to actually deduct the service revenue from that ticket revenue line item. Okay, so we need all those three components. Tell me what is the problem? Why is this a problem? And how do I fix this now? Now that I'm here, how do I fix this? Okay. If we move on, other revenue, no adjustment meets the gross income definition, taxed on earlier of receipt or accrual. Okay. So we are told what other revenue constitutes of in your second attachment. They tell us here that other revenue represents mainly food and beverages sold on flights to passengers. So this is the same information that they gave us in the pre-release, but now there's additional information on the day. They say, also included in this amount is a profit on the sale of furniture and equipment. On time realized a handsome profit on the sale of certain imported equipment, with the rand denominated sales price exceeding the initial rand denominated cost. So basically, for the equipment, the sales price exceeded the cost. The furniture sold as second-hand items yielded an accounting profit as well, but the sales price does or did not exceed the initial cost thereof. Okay, so they sold furniture and they sold equipment. Both of them had an accounting profit. So if that is included in other revenue, what I would have said is you have omitted the tax adjustment relating to the sale of your furniture and equipment. Okay, so that's the issue. They've omitted whatever applicable tax adjustments relating to the sale of your furniture and equipment. All right, why is this a problem? This is a problem because any accounting profit is exactly that. It's an accounting adjustment and it needs to be reversed because we are only supposed to be including your tax or your income tax adjustments. What are those income tax adjustments? Okay, what are those corrective measures that I need to do? You need to deduct the accounting profit and calculate a recoupment. Oh, a recoupment. What is a recoupment? So then you explain to me that a recoupment would be calculated as your selling price less your tax allowances previously claimed. So those your selling price less your tax value. How do I calculate my tax value? It's your cost less your allowances that were previously claimed. And then that recoupment, you would need to add back in your taxable income. Oh, okay. Is that all? No, there's a capital gain that you will also need to consider. And there is likely going to be a capital gain on the sale of the equipment because we are told that the sales price exceeds the cost. How do I calculate a capital gain? A capital gain is your selling price less your recoupment, which gives you your proceeds, less your base cost. Oh, okay. So what's my base cost? It's your cost less your previously claimed allowances. And if you have a capital gain, you need to make sure that only 80% of it is included in your taxable income. Oh, okay. If I have a capital loss, because remember, there is a possibility now that your equipment may have resulted in a capital loss. If there is a capital loss, then it needs to be deducted or utilized against any capital gains before you actually get to your net capital gain where you can apply the 80% apportionment or 80% inclusion in your gross income. Apologies, it's not an apportionment, it's an 80% inclusion. We are using the right terminology. Okay, so if you said that, ladies and gentlemen, discussed the deduction of the accounting profit, discussed the recoupment, and discussed your CGT implications, and explain every step of the way, how would I calculate a recoupment? You don't have numbers here, that's fine, but you can tell them principally how you would calculate a recoupment in a CGT. That is a response that would have given you a primary indicator of competence with respect to the deductibility of your accounting profit, as well as the inclusion of your recoupment and your capital gain. But because you took it a step further in those capital gain discussions by explaining how you would calculate a capital gain and a recoupment, that now gives you a high-level indicator of competence. So it's not sometimes, I'm going to just put a blanket statement, that it's not that difficult to get those high-level indicators of competence. It's in the detail that you put that will ultimately show the reviewer that you know what you're talking about. So don't just brush things high level, get into the details of how would I calculate a particular amount. If you are saying that the correct treatment is a recoupment, okay, what's a recoupment? How do I calculate a recoupment? So if there's details that you can give those details, but those details don't need to be far-fetched, guys, okay? So when I say far-fetched, I don't want you to now talk about ring fencing of capital losses and stuff like that. There's nothing in this particular context that could have triggered that particular discussion. The only thing you would have said is, oh, if you have a capital loss, make sure that you net it against your capital gains to calculate a net capital gain. Don't go off a tangent now when you are giving details about all your possible things that you know about capital losses that are not even relevant to the case study. Remember, context is everything. Okay.
Sorry, before you move,
All right.
I just would like to ask, in terms of the audience, the reason why we're going into like the detail of what constitutes capital gains and like the calculations and so forth, is it because Julio is someone that doesn't have experience? Had it been the previous person, which is Tanya, would we have to go into that detail on how you actually have to calculate it?
I like that. I like that. So I would have gotten into that detail regardless of whether I'm talking to Tanya, who is someone who's probably done this calculation before. And the reason why I would have gotten into that detail if it was Tanya is if she knew about it, it would have been in this calculation. That to me says if it's not in this calculation, I don't know. I don't know if Tanya remembers or she missed it. I'm just going to give her that detail so that she's aware if she wasn't aware. But secondly, to your point, more so because it's a junior person who's never done this, that detail becomes of utmost importance for you to add there. Okay, so I would have given it regardless, and the reasons why I'm giving it are different. For Tanya, I would have probably said I'm getting into this detail of how to calculate this particular thing because I'm not really sure if it was just an omission or an oversight. But now for this person who's Julio, I know for sure that he hasn't worked on this particular thing. So I'm giving that detail so that this is an awareness now from Julia's perspective. Is it making sense, guys?
Yes, thank you.
I'm feeling hot. Is this how you guys feel when you are writing the exam? Okay.
More than that.
Flames. But don't worry. We are adequately prepared for the flames. Adequately. Okay.
I have a question here, Katla. Can you just
Yes, sure.
clarify something for me? So the last part of that paragraph, the sentence says, but the sales price did not exceed the initial cost thereof. So was it really necessary to go into the details of the CGT?
Yes, it was necessary because even if that sales price did not exceed the initial cost, you won't have a capital gain, agreed? But you have a possibility of a capital loss. And a capital loss is also something that you would need to consider from an income tax perspective. Because when you submit a return, right, if you have capital losses, say you only made capital losses in this year, you disclose those capital losses in your tax return. So in your pre-release, when you were researching, because they told us, Moss, that the tax return is due end of the month. So this calculation they are doing for tax return purposes. So in your tax return, when you were researching in your pre-release, you would have seen an example of a tax return that it includes disclosures of capital losses. So 100% you would have still discussed those because this calculation is for purposes of your return, which also requires a disclosure of capital losses, even though you don't have capital gains. Happiness.
Yeah, thank you. Thank you.
Okay. Fuel costs. No adjustment incurred. It's in the production of income, thus tax deductible. Forward agreements have no tax impact. So there's nothing else that we know about the fuel costs, either from pre-release or information on the day. Happiness. you will see in the solution that SAICA just has commentary around the fact that they agree with that treatment. But like we said, from a time perspective, we're only talking about issues or concerns. And from indicators of competence, SAICA also only gave indicators of competence for issues, concerns, or omissions identified. They didn't give indicators for anything that was done correctly, because the point of a review is problems, issues. What are the concerns? Okay. Hey, okay. Employee costs. No tax adjustments in the production of income, thus tax deductible. There's an unconditional obligation to pay the bonuses, thus tax deductible. So with this particular one, we were told there on point 3 that included in the employee costs is the current year movement with respect to your provision for bonuses, okay? Current year movement. So what perspective are they talking about here? They are talking about the income tax perspective. If included in the employee costs is the current year movement with respect to your provision bonuses, then they tell us that the bonuses are determined based on the year-end results, but employees are only entitled to these bonuses if they are employed on the date of payment, which is typically 3 months after year-end. So they're telling us that the current year movement is included in these employee costs, which would be that income statement movement. And back to that example that we did on Excel, that income statement movement needs to be added back. All right. Why does it need to be added back? Because bonuses. So you could have given 2 reasons for this, or you could have approached it on 2 ways. The first reason you could have used is the provision reason, where we say provisions do not represent expenditure that is actually incurred because you don't have a unconditional legal obligation to settle them as yet. Or another person could have said, hold on, a bonus is a variable remuneration. It's section 7 cap B, which says that you only incur that cost when you've actually paid it. So whatever current year movement, I would need to add back and then only deduct the payment once it is made. And we are told here that the payment is made 3 months after year end, so it wouldn't, I wouldn't expect it to feature in this FY22 calculation. Happiness. So bonus deductible when paid in terms of section 7 cap B. If you use section 7 cap B variable remuneration as your reason, that would have been correct. Or if you use your normal provision sort of like reasoning, where we said, remember, provisions don't represent costs actually incurred. And why? Guys, please, it's important when you are responding, don't just leave it there and say bonuses do not represent costs actually incurred. Because in my mind, I'm thinking, why? Remember, explain. Explain yourself, guys, explain. They don't represent costs actually incurred because you do not have an unconditional legal obligation to settle them as yet. Okay? So explain, explain, explain. Landing and parking fees, happiness, there, no adjustment in the production of income, thus tax deductible. Okay, there's nothing else about the landing and parking fees that we know. We from information on the day, the only thing that we know is from the pre-release where they told us that these landing and parking fees, how is ACSA going to get them? The airlines pay them directly. So those are actually costs that are incurred. So we are happy in that regard. We don't need to be discussing those in our response. Okay. Maintenance costs. They say we added back these maintenance costs as one time is not the owner of the aircraft, thus no tax deduction. Also, no adjustment for maintenance costs related to the replacement of the significant parts. All right. So we are told in item 4 that the amount, so item 4 relates to the maintenance costs. The amount relates to routine maintenance and day-to-day servicing of aircrafts. Included in the amount are costs associated with the replacement parts and consumables. So there's 2 components here. We have routine maintenance for day-to-day servicing, and then we have replacement. This person said the entire maintenance costs we are supposed to add back, and the reason that they provided is because one time is not the owner of the aircraft. Okay, so that is incorrect, all right? Because with respect to your routine maintenance costs, right? In terms of Section 11D, your normal repairs and maintenance deductible because they are costs incurred in the production of income, irrespective of the fact that OTA is not the owner of the aircraft, right? Because your routine maintenance costs are not capital in nature. Okay, so with respect to your routine maintenance costs, we can get them as a deduction in terms of Section 11D. Why? They are incurred in the production of income and they are not capital in nature. But with respect to your replacement costs, right? Those replacement costs, we would need to add back, right? And the reason why we'd need to add them back is because they are capital in nature. And then from an income tax perspective, OTA would also not be allowed any wear and tear, right, on these particular replacement costs because rightfully they are not the owner of the aircraft. Remember, wear and tear allowances are associated with ownership, okay? You're not the owner of something, you can't get wear and tear allowances. Okay, so with respect to this 125 million rands, we needed to make sure that we are discussing two elements: your routine maintenance day to day and also the replacement costs. Okay. I did see, ladies and gentlemen, as I was going through the comments on the chat, that there was some question about which of these adjustments would obviously impact your tax rate recon. Remember when I started, I said adjustments that would impact your tax rate recon are permanent adjustment or permanent differences. Can someone tell me what is the difference between a temporary and a permanent difference? I'm going to quickly look at the chat.
A permanent difference is one. A permanent difference is one where there is no doubt a tax that's disallowed. So, for instance, it's either there's no treatment from the tax man, or there's no deduction or allowance or whatever. And a temporary difference is a timing difference between when we are treating it in accounting and when the tax man is treating it, but there is treatment in both instances.
100% spot on. Okay, so temporary difference, there is a treatment with respect to both the Revenue Authority and accounting. It's just a matter of timing. When are you going to be recognizing that treatment? For example, provisions. For accounting, you are recognizing that amount as an expense as and when you are making those provision valuations. But from a income tax or from a Revenue Authority perspective, you can only get that expense as a deduction when you've actually incurred it, when you've paid it, right? So those are your temporary differences from a timing perspective. Permanent differences, it's either there's a difference in treatment with respect to how we treat it from an accounting perspective versus the Revenue Authority on a permanent basis. So we will never align when it comes to how we are treating those items. And one or such an item can be those replacement costs. Because like we said, for the replacement costs, from an accounting perspective, they would have probably capitalized them. So they may be calculating depreciation that is an expense that reduces your profit before tax. Or even if they didn't capitalize them, maybe they just claim them as an expense from an accounting perspective. But from your tax perspective, those replacement costs, they are capital in nature, so we are not getting them as a deduction. But we are also never going to get wear and tear because this is not our asset, right? These aircrafts are not our asset. So that's a permanent difference. And a permanent difference would then be or would impact your tax rate recon. Okay. Happiness. Okay. Before I move on, I just see there's one Mulalo, I do see, or Tshego rather, someone is asking about Section 24I, your FECs and stuff. We are still going to talk about that. I just want to quickly address something here quickly. Okay, I like how we're unpacking everything. Where you define, this makes anxious about the amount of time I would need to spend on this task alone. Can I be rated competent if I don't cover all line items in the IUD? Danger, gevaar, ingozi. Do not do that to yourself. Please, guys, you are putting yourself at a disadvantage if you do not address all the line items, okay? That's why I'm saying to you, from a timing perspective, if something has been treated correctly, leave it out, okay? Address all the stuff that are issues, concerns, and all of those stuff. But in addressing those stuff, if you just tackle those 3 components that I'm talking about, then you should be okay. In tackling those 3 components, be concise. This, guys, will only come with practice. You are not going to learn how to be concise on the day of the exam. Not when you are stressed about all the other tasks, about all the information on the day that is throwing you off. You are not going to learn how to be concise on the day. Learning how to be concise starts now, effective 14 November 2024. When you are doing your case study preparations, guys, like Unati told you earlier on, quality over quantity. That quality is putting yourself under exam pressure. And I know, guys, it's difficult for you to sit 8 hours in a day in order for you to do your case studies as an example. And also sometimes you probably think, I mean, this is just my mock exam. No one really cares. No one is looking at me. Yeah. But your future self is going to thank you. Come the 4th of December, you're going to thank yourself for sitting and practicing for that 8 hours. Guys, you need to absolutely do it, because things like writing fast or being concise, but making sure I'm including all those 3 elements will only come with practice. Okay, so unfortunately, skipping stuff is going to put you at a disadvantage. The only thing that I can tell you now is you need to be the Usain Bolt of typing or writing, and that will only come with practice. Okay, guys, please, you need to do that. I'm speaking from experience. I sat down and I did it. I practiced. I sat down on Saturdays and Sundays for 8 hours. It was not fun, but you can do it. Okay. Let's move on. I do see questions that are also coming through here. Let's see. Rafua, let me see for IFRS. Since IFRS does not allow recognition of revenue on behalf of third parties, would it also be correct to factor it in and mention that no adjustment is required, as this amount ACC fee was not initially included within the... Oh, you see, Rafua, high level thinking there. Lovely. I love it. Guys, remember, this is a professional paper. Okay. There's no right. Okay, maybe let me rephrase that. Because yeah, there's things that are absolutely wrong, that you can write. And the person says, they're just going over like wrong. And you can see that this person, they didn't even read the legislation. So there's definitely wrong stuff. However, just like Rufua has said, if I'm the examiner and I'm sitting there and there's nothing else in the case study, please, guys, please, context. If there's nothing else in the case study or the previous tasks that could have alerted or shown me that this service charges were probably included in revenue, then that point that Rufua has just noted is also brilliant for you to include there. All right. And it's 100% spot on to say, from an IFRS 15 perspective, I would have expected you not to include this because it doesn't allow for the recognition of revenue that's related to other parties. So I'm happy if there's no tax adjustment, but the reason that you are including shouldn't be that reason. Because remember the reason that they included, if I quickly go there, it said that ACSA passenger service charges amount should be taxed as it was received by on time, even though it did not accrue to the company. So you just say that I'm happy if there's no adjustment, because I wouldn't have expected there to be from an IFRS 15 revenue point of view. But this the reason that you are giving is also totally incorrect, because that amount doesn't accrue to OTA because it's not for their own benefit. So that's HC. Okay. Mulalo, was the recoupment AC? No. The recoupment was not a HC because the recoupment is a normal thing that you would expect if you are covering the disposal of something. But it's the detail around how to calculate that capital gain, for example, that 80% inclusion that would have given you that HC. Okay, guys, I want us to move on just in the interest of time. Okay. Maintenance costs, we covered. So we said the actual maintenance costs, section 11D, improvements, capital in nature. Okay. Commissions paid, no tax adjustment in the production of income, that's tax deductible. Once again, there's nothing else that we were told about the commissions on your pre-release or your information on the day. So I'd be happy if you left it at that point. But another thing, when I see commission paid, guys, when I see commission paid in any task, I'm always thinking to myself, was this commission paid to the employees? Because if commission is paid to employees, it's a variable remuneration in terms of section 7 cap B. And then the question I'm always asking myself is, now, is this commission the amount that you actually paid, or has it been raised as an accrual some way? So that could have been just a one-liner, like, don't go now into discussions about, oh, section 7 cap B says commissions are variable remuneration, therefore with variable remuneration you can only deduct it when paid. Oh, you are going on and on about something that's not really an issue. It would have been just a consideration that you could include and say, we also need to consider if any of that commission is commission that is paid to employees, because if it's to employees and it's not yet actually paid, i.e. it has been only raised as an accrual, we would need to add that back because it would not represent a cost actually incurred in terms of section 7 cap B. Fast, one line item that shows me that you are thinking critically about the possibilities of all line items. Okay. Customer reservation charges, no adjustment in the production of income. Once again, this was an item that there wasn't any other further information that we could dig deeper into. Unrealized loss on foreign exchange contracts, FECs. So they say we need to add back the 1.5 million unrealized loss on the FEC included in other operating costs, as this is not deductible in the 2022 year because it has not yet been incurred. So these FECs we were told about, I think it is point 2, where it says your other operating costs include an unrealized foreign exchange loss in respect of an FEC. So your foreign exchange gains and losses, ladies and gentlemen, are governed by section 24 cap I. Okay. With respect to section 24 cap I, section 24 cap I says that you can deduct foreign exchange losses or tax foreign exchange gains unless it is unrealized foreign exchange gains and losses with connected parties with respect to non-current assets or liabilities. So with respect to this unrealized loss on foreign exchange contracts, yes, it is unrealized, but it doesn't relate to a connected person. Well, at least they didn't tell us that. And they also didn't specify whether this relates to a non-current asset or liability that they were revaluing. So this can actually be deducted in terms of section 24I, and that adjustment is therefore not correct. Okay. So please, ladies and gentlemen, exchange differences are deductible in terms of section 24I unless they meet the requirements that I've just noted now. If they do meet those requirements, then you would need to reverse. If it's a loss, how do you reverse a loss? Add back. If it's a gain, how do I reverse a gain? Deduct. Remember to use doing words, verbs, okay? Other operating expenses. Included in other operating costs is the annual insurance premium of 567,000 that was paid to an insurance company on the 1st of October 2022. So this annual insurance premium relates to a short-term insurance cover for vehicles, furniture, and equipment. The annual premium covers the period of 1 October 2022 to 30 September 2023. Okay. No adjustment in the production of income, that's tax deductible. So that is incorrect, because although they've correctly identified that the insurance premium is a cost that is incurred in the production of income, but there's a prepaid element of this cost because it covers a period from the 1st of October 2022 to 30th of September 2023, which is 9 months after year end. Okay, so our year end is 31 December 2022. So that prepayment portion is 9 months after year end. And in terms of Section 23 Cap H, this premium would or the benefit thereof, or the service would only be utilized 6 months after year end, because the prepayment period is 9 months. And in addition, that total prepaid amount, if you take 9/12 and you multiply it by 567,000, you will see that that prepaid amount is in excess of 100,000. So meaning that this prepaid portion is going to be limited from being deducted in terms of Section 23 Cap H. Please, guys, prepayments are not deductible in terms of Section 23 Cap H. Your deduction is in terms of Section 11A, but the limitation is in terms of Section 23 Cap H. So use your terminology correctly. Sometimes it's not because you don't know or you don't have an idea from a technical perspective, but you are not describing things correctly. You are not using the correct terminology. A person will say, oh no, you've incorrectly treated the insurance premiums. The premiums are not deductible in terms of Section 23 Cap H. Section 23 Cap H doesn't say anything about deductibility. It talks about the limitation of a deduction. So the deduction in terms of Section 11A is going to be limited by Section 23 Cap H. That's very, very important. Okay.
Hi, sorry, Katleho, to cut.
Yes, Sama?
I just have a question. What if you said this insurance, although it's like prepaid, does not result in a deduction, as the insurance is to cover income producing structures such as vehicles, furniture, and not really an income or not really to protect the income or revenues of the business. So if you said it's like capital in nature.
Okay, so you don't believe that the premiums are incurred in the production of income?
Yes, yeah, would that be a viable thing? Because the box here says that this annual insurance premium relates to short-term insurance cover for vehicles, furniture, and equipment.
Okay, so that wouldn't have been the correct response, because insurance, ladies and gentlemen, even though it's to cover, the assets that help you to produce your income, and that's where you actually get why the insurance premiums are in the production of income. You are not going to be able to operate effectively if your vehicles or your furniture and equipment are not there, right? So if you lose these particular items, the fact that you are going to have some sort of insurance to make sure that you cover them is going to allow you to continue to produce income in your entity. So that cost that you are incurring is ultimately in the production of income, because it is ensuring the continuity of your income earning operations. This is not the insurance proceeds that you would have received if your vehicles or your furniture were lost or damaged or whatever. Because if it was those proceeds, then those proceeds are capital in nature, because then they are going to be replacing the actual capital structure, the asset. But the premiums, the monthly deduction, I'm incurring a monthly deduction so that I can ensure continuity of my operations should anything happen to my capital assets. So that reason is not, wouldn't have been correct for this particular case study.
Okay. Thank you. So even if something is in the production of income, does that not mean that you can say that it's capital in nature? Or is it just particularly for the insurance? Because obviously insurance of assets directly impacts the income that we can get.
Okay. Maybe what we can do is, if you give me another example where that particular underlying cost that is covering a capital asset is also deemed to be capital in nature, or that you believe would be capital in nature, and then let's talk about it on Viva, okay? Just in the interest of time. Is that okay?
Yeah.
Okay, let's talk about it in Viva so that we can see the distinction between the two. If there's any, maybe an example that you saw that led you to probably maybe believing that these insurance premiums could possibly be capital in nature, and then we'll engage on that app. Okay. All right. Then we have that the deduction limited under section 23 cap H. Then we have our office cleaning costs. Office cleaning costs for August 2021 to December 2021. We forgot to claim this in the 2021 tax return in the production of income, thus tax deductible. Error. If we went and we researched on, or we reminded ourselves rather, on the requirements of section 11A, the general deduction formula, you know that cost must be actually incurred during the year of assessment. If you forgot for some reason to claim a cost in a previous year of assessment, you have to go and open that return. So you cannot come into the current year return and be putting things that do not relate to that particular year of assessment. So you will, in the solution, that would be a item or a reconciling item that actually goes into your tax rate record, because now you have cleaning costs that are sitting in your profit before tax as a deduction, right? Or rather in your retained income or somewhere from an accounting perspective. However, in your tax perspective, you are now never going to be able to get that deduction unless you go and you reopen that tax return. So this is one such item that for 2022 purposes, it's then going to be a permanent difference, because unless you're going to opt to go and reopen that return, then you cannot, there will be a discrepancy between how this was treated for accounting versus how it's treated for income tax purposes. Then we have depreciation, ladies and gentlemen. This is an accounting entry that needs to be reversed for tax purposes. They added it back, so we are happy with how they've currently treated it. So we don't have to say anything in that regard. And why do we not have to say anything in that regard? Because on the second slide that I'm showing now, they showed you that they've also added back depreciation on your other assets, and then they've described them: vehicles, furniture, also your leasehold improvements and equipment. Why is this important, ladies and gentlemen? If you are reading the scenario or you are reviewing the financial statements, and you can see that they've described various assets, right? They've described equipment, furniture, etc. But in the depreciation that they are adding back, they probably just added back depreciation and then they wrote in brackets vehicles. It's a valid point to ask. I see you're adding back depreciation, which is correct because it's an accounting adjustment, but I'm not seeing depreciation on the other asset types, because in your financial statements you said you have equipment, you have furniture, so those things are also important that you pick up. Okay, but in our case they cover depreciation on all of the assets that they described, so we don't have to say anything there. So it's in the little things also sometimes where you need to just read and understand. Don't just say depreciation, oh no, they added it back, I'm happy. But are they adding it back in its entirety based on your understanding of the type of assets they have? That's also something that you're going to need to consider or think about. Or for example, if they just said depreciation, they didn't describe here what assets they're including. Also, for example, here, if they didn't describe that this is depreciation on right of use assets and they just said depreciation, it's also a valid point to ask yourself, and say, I would probably need more information for you to let me know if that depreciation amount includes all of the assets that you described in your balance sheet. However, with that said, it wouldn't be relevant if you can see the total depreciation amount that they add back, for example, agrees to the income statement that they gave you. In that case, then you can say, oh, okay, then that's fine. I see that the depreciation, even though you didn't describe what it relates to, the amount agrees to the income statement. So from that perspective, I will say it's complete. Okay. Do you see how you have to analyze stuff, guys? You're not just analyzing the line item. Analyze also the description, like read what are they actually adjusting here. That could also give you more points to add on into your review. Okay. Wear and tear on vehicles, furniture, and equipment. 5,800. This is wear and tear allowances calculated based on the right-of periods in binding general rule number 7. No tax allowance on right-of-use assets, as this is an accounting entry. All right. Happy that you have included wear and tear. It's also on vehicles, furniture, equipment. I'm happy. If they said any wear and tear on aircrafts here, we would have said no, because, I mean, the aircrafts aren't yours, right? Similarly, they said no tax allowances on right of use assets. We agree with that. What we are disagreeing with, or what we need to question rather, is this amount, this 5,800. How was it determined? Because now you didn't explain in your reasons. You just said wear and tear calculated based on right of periods in binding rule number 7. I will need more information about the right of periods that are applicable to the assets in order to get you to this 5,000, or rather 5.8 million. Sorry, it's 5.8 million. Then you can say, because, for example, interpretation note 47 gives you, I think it's 3 years on vehicles, or 5 years if I'm not mistaken, but that 5-year versus 3-year, you would have researched during your pre-release, because they told you in your pre-release the type of assets that this entity has. So you would have went to go see what would have been the applicable right of periods for these particular assets. It's absolutely unforgivable if you are going to be looking at right of periods on the day for assets that were described in the financial statements. That's unforgivable. That shows that you didn't do enough preparation. So in your preparation, when you see asset types, understand right of periods right there and then, so that on the day you can write quickly. If they say 2 minutes left, muscle memory will help you pull that 3 years, because you would have remembered that for vehicles there was 3 years that I researched on. You don't now need to go open your legislation. Okay. Interest expense. Okay. Oh, it's a good thing I opened this up. Section 11G. So remember, ladies and gentlemen, there were leasehold improvements that we were told about, and they added back depreciation on leasehold improvements, so we are happy. But with respect to the wear and tear, they only spoke about wear and tear on these assets. They didn't say anything about leasehold improvements. So you can also question and say, because I also don't know what's included in this 5,800, please be cognizant of the fact that if there's any wear and tear that you calculated somehow in terms of Section 11G for the leasehold improvements, that would have been inappropriate, because Section 11G is only applicable to land and buildings. And how would you have known this? During your pre-release. Why? They told you through the financial statements that leasehold improvements was one type of asset that they had there. So you would have had to go and research during the pre-release extensively on Section 11G. And why would you have done extensive research? Once again, it's the context or the information that you were given on during your pre-release. Your interest expense on lease liabilities, they said no tax adjustment in the production of income. That's incorrect. Why? We already spoke about this earlier on. We add back interest, we deduct actual lease payments, because interest is an accounting adjustment. Payments is what you've actually incurred. And then your annual learnership allowance, they claim the tax deduction for the learnership agreements. We are happy because Section 12 Cap H would be applicable to your learnership agreements. But for this, you would question the amount also, because you don't know. They didn't describe what level were these participants in this learnership agreement. So you would just phrase it as a question to say, you would need to give me further information about when they entered into the learnerships, what level of certificates are they studying? Is it NQF level this and this? And give them a reason why. It's because if you are in NQF level 1 to this, you can get an allowance for 40,000, for example, per annum. Okay. Then we come to your assessed loss. They said the higher of 1 million and 80% of the assessed loss. So they're basically limiting the assessed loss that they can claim. This is incorrect because the Section 20 limitation of your assessed losses was only applicable for the years of assessments ending on or after 31 March 2023. And how would you have known this? Once again, in your financial statements, you are already told that from an accounting perspective, they're making a loss. So you would have had done extensive research on your assessed losses. If you didn't do research on your assessed losses, then you were shooting yourself in the foot because they basically told you from an accounting perspective that they're making losses. So high chance of making actual assessed losses. Remember, loss before tax doesn't mean assessed loss, but the chances are high if you have a loss before tax. Then tax rate, right? 27%. That's wrong because the tax rate for 2022 was still 28% because it only changed for years of assessment ending on or after 31 March 2023. Okay. So guys, I see that we are way above our time. It's 10:01 on my side. I just want to quickly talk you through the other considerations, which I'm just going to pull up now. We've already discussed some, but I just want to quickly talk you through the others, and then we will call it a night. Please, guys, let's engage on the Viva tool. If there's anything that you believe hasn't been adequately addressed, we can engage. But these are not free consultations. If I see that now this needs extensive, research for me to look at the case study and all of that, then we go into the consultation realm. Ele, that's fair, ne? I don't know if Ele is still around.
I'm here, Katlego, and hoping that you don't get me fired here.
Yeah, please,
but
guys.
go for it. 5 minutes, please. Otherwise, I'll wake up without a job. My kids still need to eat.
Okay, quickly. These are the other items that you needed to consider. And guys, why are these other items? Because they were not specifically noted in the tax calculation. But why are they important? Because it's things that you would have expected to be there in the calculation. Why would you have expected them to be there? Because the information that you were provided during your pre-release touched on these stuff. It addressed these stuff. So these are omissions that you should have actually highlighted. Okay. Interest income, we were given in the financial statements. So you could have asked there and said, I do not see any tax adjustment with respect to interest income. We just need to make sure that our interest income complies with the provisions of Section 24J. And please feel free to let me know if there's anything that is of concern to you with respect to interest income. And why would that be okay for now? It would be okay for now because they didn't give us anything with respect to interest income. But for example, if you are saying, please let me know if there's anything further with respect to wear and tear, hard no, you don't get the indicator of competence because you were given enough information to make a conclusion on what the appropriate wear and tear rates, for example, would have been. But for interest income, they didn't give us anything. Like they were totally silent. No additional note, nothing else that could have helped us look further. So that particular prompt to the reviewer to say, let's consider Section 24J, please let me know, would have been sufficient. Provisions. The only provisions that they told us about was the bonus. We discussed it, but there were other provisions that they noted in your balance sheet. So you could have used the very same thinking that we spoke about to bring in the provision as a omitted item that you would have expected to see. Trade and other receivables. Please, guys, whenever you see a trade and other receivable amount on your balance sheet, you need to think about the ECL allowance, which is your provision for doubtful debts. It would fall under the provisions that we discussed. But what is accompanying that? Section 11J allowances. You can't see trade debtors and not research on Section 11J. And then you would have then needed to ask them here that we need more information on how your provision for doubtful debt allowance is calculated if there is a provision on your trade receivables, because if it is calculated in terms of IFRS 9 and is based on lifetime expected credit losses, then you can get an allowance in terms of Section 11J of 40%. Okay, so that to the reviewer shows that you are thinking critically over and above. You are bringing more things that are relevant, relevant to the case study. Okay, we're not just thinking about random other stuff. The last but not least, it's deferred revenue. We were told that there's deferred revenue there on the balance sheet. This is an adjustment that you would have expected. Why? Deferred revenue is income received in advance. You've received it because we are taxed on earlier of receipt on accrual, and therefore this is an adjustment that you would have expected. Okay. So thank you, ladies and gentlemen. I sincerely hope that you got what you were looking for. Have a good night. Prepare, guys. Prepare, guys. Prepare, guys. The 4th of December is soon. Before I go into a motivational talk, I'm going to end it there. Okay. Thank you. Rejoice, I do see you have a hand up.
Yes, thank you so much, Katlego. That was a wonderful session. I just wanted to confirm that with the deferred revenue that we'll pull from the balance sheet, it's something that would add back because it's gross income in a sense that it's received at the ela, what's this, recognized or recorded at the ela of receipt or accrual.
But remember, with balance sheet amounts, what you always have to do? Talk about the reversal.
Yeah,
So
because now, it's income. So deduct and then add.
Yes. So with balance sheet amounts, if you're talking about balance sheet amounts that have a tax impact, if you are adding current year, you reverse last year. If you are deducting current year, for example, prepayments are a deduction in terms of your current year balance. Opening balance, you'd need to add back. So whenever you're talking about balance sheet amounts, don't forget last year's reversals. Don't forget last year's reversals.
Yes.
But in the reversals, use verbs, doing words. What do you mean reverse? I don't know what it means to reverse, only when I'm driving. But reverse means deduct.
Sure. Okay. I think it helps when I start with the current year because when I think deferred revenue, then it will be gross income. Then I'll start adding the current year, then means I deduct the opening balance. So, okay, sure. Thanks.
Okay. Thank you, guys. I'm seeing your comments. I appreciate it so much. It shows you lecture CTA. Yes, I do, or I did. But please, guys, ask questions, and we are here to help you. Okay. Thank you so much.
Thank you, Katlego. I think you've went over 8 minutes.
Yes.
It means that you owe me probably about 4 consults. I know you're difficult to find, so I'm getting you here with the 243 witnesses.
Oh, please don't hold me to a consult.
I'm in the phone. Thank you.
Great.
Thank you, Katlego.
Thank you.
Thanks. Don't
Bye.
worry. I'm gonna try. It'll be it's first come first serve. Her rate is like 10,000 per hour clearly. So I can only afford probably couple of slots.
We can only afford a couple of slots. We can only afford a couple of slots. But thank you so much.
Cheers. Thank you so much, Katlego. Much appreciated.
Thank you. Good night. Bye.
Bye.
Bye.